Hello, I'm Avnish Jain. Welcome to Canara Robeco monthly fixed income call. The last 2 weeks have been filled with news, and I will take you through various news items both globally and locally. Globally, President Trump was sworn in on 20th of January and he immediately started with all the promises he had made on tariffs, immigration, etc. He hit Canada and Mexico with 25% tariffs on Saturday, was 2nd of February. But immediately after talks with the respective presidents, he decided to delay the tariffs by about 1 month. So steps can be taken by Canada and Mexico to reduce the flow of drugs and immigrants into the US. Trump also hit China with 10% tariffs, and as of now, there is no news of it going back on that. In turn, China also has done some counter tariffs on US imports into their own country. This has led to large volatility in markets. US markets, especially the equity markets, saw large upheavals and up and down movements. In India also, we saw equity markets go up and down in response to US tariffs. In all this noise, the US Fed meeting went unnoticed. US Fed did not do anything on rates, and as per latest information, it is likely that the US Federal Reserve may remain on hold for some time as inflation remains sticky and growth remains robust. The latest labor numbers are also showing some weakness, but they still remain quite strong. In terms of India, budget was the biggest surprise which happened on 1st of February. For first time after many years, income tax was cut for the middle class, where up to 12 lakh of income was made tax-free, and various other cuts were done to benefit other taxpayers as well. This is likely to have cost the government about 1 lakh crore in revenue, which will be filled up by cut in other expenditures in the budget. The government, however, chose to stick to the FRBM glide path, bringing down the targeted fiscal deficit for FY26 at 4.4% against expectation of 4.5%. The fiscal deficit for FY25 has been calculated as 4.7%, which is lower than 4.9% as was budgeted last year. Overall, the government fiscal prudence has come to notice, and government has been very careful to ensure that fiscal spending does not get out of control. Coming to rates, I think the rate markets have been very positive, especially with RBI announcement on liquidity measures. RBI also announced liquidity measures about 10 days back, where they have announced open market operations of 60,000 crores to be done up till February, and also USD bill INR swaps of $5 billion, which will inject approximately 1 lakh crores into the banking market by end of February. The liquidity deficit was created by RBI FX operation, which is now somewhat filled by the actions taken by RBI in the last 10 days. We expect RBI to continue with more OMO operations probably in March and April to ensure that liquidity remains near positive and not a big deficit as was earlier, which could hamper growth. RBI actions also stem from the fears that growth slowdown may be protracted, and they may have to take further measures to ensure that growth continues to remain robust above 6%. Going forward, debt market rates are likely to trade between 6.5 to 6.65 range, even after a rate cut, as market would be looking at global events as well. The tariff war is still not over and has just started, and that itself will continue to plague markets, especially from a volatility angle. From a fund side, from an investment perspective, we still believe there is a lot of value in the front end of the curve, while there has been some correction downwards of yields, and we have seen some rally in the 1 to 2 year rates. Post RBI's OMO announcement, the rate cut itself should give more downward pressure on the short end of the curve. The 10-year rates have already fallen by about 10 basis points post OMO announcement. We do anticipate that the spread between 5 to 10 should also increase further post the expected rate cut in the upcoming RBI policy. From that angle, investors may choose to invest in funds like ultra short-term fund and savings funds to take advantage of this opportunity in the rate cut cycle, which is likely to start in the next 1 week. For long-term investors, there is opportunity in the long-term curve with long-term bonds still above 7%. As rates fall in the front end of the curve, the long bond should also react, and they should give opportunities for investors in funds like gilt, income and dynamic bond funds. As always, investors should keep their risk profile in mind as well as their investment duration while making investments in mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.